Hi everyone, this video is to show you how to use the allowance method for bad debt. So allowance method. The accounts we will be using, pay attention to these two accounts. One is called bad debt expense, and the other one is called allowance for doubtful accounts. All right, and bad debt expense is an expense account. Allowance for doubtful accounts is contra asset. To be more specific, contra accounts receivable. AR, accounts receivable. All right, so allowance method is the proactive method. And it uses estimates. Those are two very important characteristics of allowance method. Proactive, because in this method we do not wait for people to actually default on us to start recording bad debt expense. Bad debt expense instead is recorded in the same year that the sales are made. So if you think December credit sales, typically customers will pay in January the following year, January or February. With allowance method, what the company will do is for December 31st of that year, they will, even though people didn't even start to pay and you don't know who is not going to pay and how much won't be paid, you will make estimates of how much you think bad debt expense is going to be based on this year's sale. So you do not wait till later, you record bad debt expense ahead of time. So typically it's recorded on December 31st of the year. Okay, and there are two ways to estimate. Since we're talking about estimate, there are two ways that you're learning in this chapter. One way is called percent of sales method. The other one is called percent of accounts receivable method. So the percent of sales method is considered a income statement approach. And percent of accounts receivable method is a balance sheet approach. All right, so the calculations are very simple. The percentages are based on past experiences. So companies usually either choose one or the other. Okay, so if the company chooses percent of sales method, it could be based on previous years. They come up with a percentage. Let's say they think they estimated about 5%. 5% of all credit sales are uncollectible. meaning customers won't pay. And if in the year the credit sales was $1 million, 1 million. If that's the case, what we do is we take the 1 million, multiply 5%, and you will get 5 4 zeros, so 50,000. Okay, so this 50,000, what do? You will, this is your estimated bad debt expense. So you will write for December 31st, you record a journal entry, bad debt expense, and then the other account is your allowance for doubtful accounts, 50,000, 50,000. Okay, now let's look at the percent of accounts receivable method. Let's say the company thinks that 2% of their accounts receivable balance are uncollectible. And this accounts receivable balance is 200,000. Okay, if that's the case, we will take the percent of the accounts receivable, which is 200,000 times 2%, and this will give you 4,000. I'm just pulling random numbers, yeah. So you know what? Okay, $4,000. And this $4,000, you want to pay attention right here, is actually what you want. So this is what desired balance for allowance. What does that mean? Well, this is the tricky part. So let's say we have this allowance account. Allowance for doubtful accounts. So in this example of this company, the 4,000 is what we want our allowance account to end up. Now, since allowance is a contra asset account, the normal balance is a credit. So in other words, we want allowance to be 4,000, to end up being 4,000. So, however, allowance usually will have some kind of beginning balance. So it's rarely like a zero beginning balance. Sometimes, let's say in this example, our allowance has a beginning balance of $700. Okay, so giving you an extra information. Beginning allowance is $700 credit, has a credit balance of $700. If that's the case, and we have to go one more step, because we cannot just take, this is a balance sheet approach, so a percent of a balance sheet account is a balance sheet account, so which is allowance for undoubtful accounts, right? So this 4,000 is the ending balance for allowance. And then, so what is our bad debt expense? Well, your bad debt expense is what makes up the difference. So if you had the 700 credit and you want it to become 4,000, in other words, you need to adjust it by 3,300, and this is what your bad debt expense needs to be. So the journal entry you're recording is December 31st, bad debt expense and the allowance. You would record 3,300 and 3,300. So this is really like the part that you really want to pay attention. For percent of accounts receivable method, you need to go one more step and consider the beginning balance of the allowance account. And the bad debt expense is not the $4,000 you calculated. Is the difference between what you calculated and the beginning balance of that account. So what if instead of the beginning balance being 700 debit, credit, the beginning balance is 500 on the debit side? Well, it's possible, it could happen. So if instead of 700 credit, it's 500, it's a debit balance 500. Now you have to redo the math. Well, you wanted to reach 4,000, but you start with 500 on the debit side. So how much do you need? Since it's 500 on the other side, it's basically a negative 500. So negative 500, add something to reach 4,000. Your answer will be 4,500. Okay, so pay attention to how debits and credits work. If it's a debit balance, it will be calculated as if the beginning balance is a negative. Okay, so 4,500, and then your journal entry, of course, here you would say 4,500 and 4,500. All right, so that is how we set up allowance. So two different methods for two different companies. Now, let's say that if we're gonna take this allowance, so one step further, this was setting up the allowance December 31st. Let's say now comes March 31st. Now it's March 31st of the following year, and a customer, March 31st, 2021, Jimco, Jimco, who owe, $300, said that they won't be able to pay. So what do you do? Well, you have already set up an allowance for it. So what you do is you're gonna take that allowance. Instead of recording more bad debt expense, you already recorded a bad debt for everybody. You don't know who, you recorded the overall bad debt last year on December 31st. So when one single customer defaults on you, you will use the allowance you've already set up. So for that $300, this person will not be able to pay you. So you will use the allowance for it, doubtful accounts, and then you will remove his accounts receivable because he won't be able to pay you. So you remove his accounts receivable, $300, because there's no reason to leave the accounts receivable there if he will never pay. Yeah, so if we take this, let me try to move my sorry, bear with me. Okay, so this was the allowance account, and we're going to, so now we had a 4,000 balance, and now when Jimco defaults on us, we will use the allowance. So now you see we're gonna take $300 out of it. Now if someone else also defaults on us, for example, another person defaults $2,000, another person defaults, $1,500, right? And in the end, we're gonna have a balance because we estimated this is what we set up. In other words, this is our estimate. And when we debit this account, is the actual, these are the actual defaults. So the actual defaults were 3,800. My estimate was 4,000. So in the end, I'm gonna have a balance of $200. That's why your account would have a beginning balance, because your estimates and the reality may not always be the same. Yeah, and that's okay. So if you can just carry that balance forward to the next period, when they calculate the balance again, you will just consider that balance again. All right, and having a balance is okay as long as it's not too huge. All right, there you go. That's the two methods, percent of sales methods and percent of accounts receivable method. And from percent of accounts receivable method, and there is one, if a more complex version of percent of accounts receivable method is called AR aging method. AR aging. What that is basically percent of accounts receivable method. However, they put the accounts receivable in different age groups. So, for example, within 30 days, in 60 days, past due. So, not due, within 30 days due, 60 days due, 90 days due, and above. And they would give a percentage to each one of them. So instead of just overall 2%, maybe they put 0.5% for this one, 1% for that one, and then the rate will grow. The older the debt, the longer, the more uncollectible the receivable will be. 3%, 5%. And then instead of, maybe this company has total 200,000 accounts receivable but 100,000 is here, and then 5,000 here, 25,000 here, and so on and so forth. Yeah, and so they would multiply each age group and then come up with numbers and then add them up together, and again, that's their desired balance for allowance. So AR aging method is just using the percent of accounts receivable method for each age group, not overall, but each age group, and then add them up together. Okay, and hopefully this helps you. And if you have any questions, feel free to send me a message. All right.